The wealthiest people in the world really only have about 15 to 25% of their net worth in the stock market. So where's all the rest of it?
Yeah.
It's in alternative investments.
What is the range that someone could potentially make in private credit funds?
Oh, probably like
The wealthy people that I look up to and I know, they're doing investments that the average person's not doing. Maybe not worth $100 billion or $100 million. How can we still take advantage of this?
Well, just because you don't have that type of a net worth doesn't mean you
Yeah.
can't copy the playbook of the wealthiest people.
Yeah.
My goal is to help people learn and grow their wealth the way that the billionaires do it.
Justin Donald,
Good to be here.
the man, the myth, the legend. I had to be in Austin twice to get you on my show.
Sorry.
I literally was at your event and you're like, hey, you're a busy man. You're like a popular dude at your own event.
Well,
So-
I got to tell you, the week of an event, and we did back-to-back events. So you had the Lifestyle Investor event for 3 days.
yeah.
And then I had Tribe of Investors the next 3 days. So I had been speaking or on stage
Yep.
6 straight days.
Yeah.
And I was just wiped out. And actually, I think I was losing my voice is what it was.
I think you're always losing your voice.
Yeah.
I think this is a common theme.
Well,
but
I don't do that crazy marathon of a
Yeah.
conference schedule, but one time a year. And so
Yeah.
my voice just can't hold. It fails me towards the end.
Yeah, so I think we met 4 years ago through Rachel Richards. I think
Oh,
that
is
was
that
like
where it
the
is?
Cutco world.
Okay. Rachel's a sweetheart.
Yeah, she's a sweetheart and has done some incredible things when it comes to the money space. She, I think, went to one of your events. I heard you speak and was like, Justin's incredible, and connected us. We did a podcast a while ago. This was probably pre me really being big on YouTube.
Okay.
And then, so we got connected. I've always looked up to you. Your book is phenomenal. And then we've just become better friends since then. It's been fun to get to know you on a friend level. It's been fun to lose and beat you in pickleball. It's been fun to interact with you. I got to go to one of your events recently, and I've always known this about you, but I was just so blown away by the frameworks and the way that you think about alternative investing. I'll be honest, when I think of alternative investments, I think of Ponzi schemes because I've known people that have lost money. But hearing you talk, and I also know like the wealthy people that I look up to and I know, they're doing investments that the average person's not doing.
That's right.
And it can be overwhelming. And so my hope is that I don't want anyone to sue us on this podcast. It's just two people talking. But I know, like, I've talked to you behind the scenes and like you give so much value in frameworks and how you view alternative investments. I just think it would be amazing if we could create almost like a masterclass because you have a couple masterminds. You've written a book. You're constantly studying when it comes to this. I just feel honored that I get to pick your brain for these next couple minutes. Before we jump in though, anything that you want to do is setting the stage of like, you didn't just stumble upon this accidentally. Like there's always a story and a journey. How did you get into this world?
Yeah. I mean, and by the way, I'm an open book,
Yeah.
so we can get into anything you
Yeah.
want to get into. My big thing is I like to teach people. I want to educate.
Yeah.
So I'm not giving any financial advice. I'm just purely teaching
Yeah.
people this world that most have no idea
Yeah.
even exists, right? So for me, I've just been investing for about 25, 26 years. And I did start by investing with a financial advisor, in kind of the regular channels, like maxing out my Roth IRA and having money in a few different qualified plans, but really like, in the way that most people would in the stock market.
Yeah.
And I was really taken advantage of and not to paint my advisor in a bad light. I just think there's a manipulation and a misalignment between financial institutions and the people that they're supposed to serve. And so even the way that these statements get created, they can shift what is a real actual return and they massage the numbers by saying, hey, the average return is this, which is not like a real depiction of what's happening. So I was in a weird situation where I never had anything that said that I was losing money. My average rate of return, had me making money. But I remember one day I looked and I was like, I'm less today than all the money I put in. How is that even possible if I haven't like lost money? But I have. Like no statement has said, hey, you've lost a lot of money. And so learning just some of these, these tactics really opened my eyes to the world of financial institutions, that they get paid by assets under management. They get paid whether they do well or not. 96% of them don't even outperform the S&P 500 index. So you pay more.
Exactly. Yeah.
Pay more money, to have worse results than if you just put it in an index yourself. And so my eyes were opened and I said, you know what? I got to do it differently. I can't outsource my financial education. If I do that, I'm doing a disservice to myself, my family, to like anyone that I could teach proper ways of investing. And it's not that the stock market is bad, but the wealthiest people in the world really only have about 15 to 25% of their net worth in the stock market.
That's wild.
So where's all the rest of it? It's in alternative investments. And so about 15, 16 years ago, that's when I started getting into that world. And I started out with real estate. I did some private credit. Early days, I did some hard money lending. I got into private equity and just, you know, for anyone who's tuning into this, in the stock market, 25 years ago, there were 10,000 companies. Now there's 4,000 companies. But on the private side, companies that are not listed, there's tens of millions. Worldwide, there's hundreds of millions. So the amount of companies on the New York Stock Exchange is less than 0.01% of the total companies out there. So why on earth do I want such a small number of companies to invest in when all the rest of them are out there? They're willing to structure unique deals. They're in need of capital, and it doesn't cost the time, energy, and money and the headache to go public. Like these companies that go public, they have these mandates. It costs millions upon millions of dollars to do it. It takes years of time. And I would argue that it's, for most of these companies, it's not what's in the best interest of, you know, the shareholders.
You're spending a lot of money just scratching the backs of the regulators.
That's right.
A couple things. Number one, indexes. Even you could be in an index and you might even not have an advisor, but you're still only getting like 7 of the, like out of the top companies, the Googles of the world, the Apples of the world. I mean, they're also like, it's not even like you're investing in 500 companies equally. You're investing in a lot of them that are, you know, a lot of them are concentrated with, you know, the 7 top 10 companies. So that's an interesting thing. The other thing is the stock market is very efficient, and people that know me like love the word efficiency. That can be a good thing and a bad thing. That you'll get market returns because it's efficient. There's really, you're not necessarily going to beat the market. What is it? Only like 5% of people beat the S&P, and those people change over time. Is that?
It's even worse than that. Okay. So in the last 15 years, 5% outperformed. 5% of money managers outperformed. But if you take 30 years, it's less than 1% that actually outperformed, right? So it's, to find someone that can consistently outperform the stock market, it's not going to happen. It's too efficient. You know, if you really believe that you have those skills, and by the way, there's 2 different ways of investing in the stock market. You can day trade, which you're not going to win that game unless you are as brilliant as they come in a technical sense. Like you cannot beat algorithms, you can't beat AI, you can't beat micro trading that can 1x, actually 1,000x the trades that you can make in that same time frame. So you're just at a disadvantage. Now, if you're banking on long-term growth of the economy, that's different. You're putting money in, you're saying long-term, I think the US is going to do well. The last number of years, the last 10 years, maybe more, it's really just been those top 7 companies propping it up, but still you're getting a piece of them. So it's so efficient. Read Flash Boys by Michael Lewis, and you'll learn everything you ever need to know about whether you can beat the stock market or not. But the wealthiest people in the world, they make their money in inefficient markets.
Exactly.
Right? They make their money where it's not so efficient because you have someone that's looking to retire and sell their business.
Exactly.
And they're a baby boomer and they're ready to be done. And so now you can get a business, maybe it's off market. There's no competition. You can do this with real estate. You can do this with all kinds of things. And now you can actually get, so, you know, you can buy a reasonably priced asset at a good price.
Okay, let's go through the masterclass of alternative investing. So someone's like watching this and they're like, hey, I get the concept. You're not saying that the stock market is bad, but you're literally saying, I think you told me this the other day with family office research, that you said less than 20% of these people's assets are actually in the markets.
That's right.
Correct me if you, but so then the next question is, where's the other 80% going? And I would love to hear your thoughts. And again, we also have to realize that there's some people, if you have billions of dollars, you probably get access to deals that even you and I don't get access to. But I am always amazed, like, especially you, like you get deals and you get access to things that are just out of this world. And it's because you've built a name for yourself over the last 15 years in the making of of being the guy that people go to. So with that, I got my notebook, man. I'm ready to take notes.
Well, reputation matters. And I think the better your reputation and the more that you go out of your way to serve other people, the more you're just going to bring, people are going to want to bring value to you. And so that's it. Like for years, I didn't have any deal flow, but I did as much as I could to always just kind of prop people up, help them out, connect. One of my favorite things is to be like a professional business matchmaker. Like someone needs to, know someone in this area, that area, and I just connect them. I don't expect anything. I don't need anything. But over time, it really adds up, and people are like, "I owe you." And in my mind, I'm like, "Not really. I was just doing that because you're a friend or because you needed the help." But to them, there's some reciprocity, and they want to say, "Hey, I got this deal, and I want to carve room for you." Normally, we don't have any room in these deals, but I actually want to give you and your lifestyle investor mastermind room to invest. So that's kind of how that works.
I'm going to take a left curve. We're going to come back. John Ruhlin was one of your best friends. Wrote the book Giftology. He actually, that book was one of the first books I read when starting my business, and it helped me start playing the long game of building through relationships. John tragically passed away this last year. Anything that you want to say from a standpoint of some of the things that you've learned, because you embody that, and it's interesting because I would have said that John inspired you, but you guys probably co-inspired each other because you guys have been friends for so long.
Yeah, we've been friends since we were 18, so 25 or 26 years. We had a guy, actually, I think it was 26 years that we were friends. And so, he certainly inspired me. I hope to think that I was able to inspire him. I mean, learning some things after the fact, it looks like he made some moves based on some of these alternative investments that I had talked about. So I'm like, yes, this is so good for his family. But tough season. His birthday's on March 16th. They're doing their book launch there. So I'm excited it's here in Austin. So I'm excited to be able to help and support.
We'll put links to all that in the show notes. And if you're someone that wants to learn more about how you can gift well, think long term when it comes to relationships, again, not in part of the show notes, but or not part of the plan in talking about alternatives, but your greatest investment is yourself. I would say your second best investment is people.
Yeah.
And if you want to do that well, we'll have that info. Okay, let's go back.
I love it.
We'll go back to alternatives.
So a lot of the data that I study is going to be for single family offices. And so what that basically means is it's billionaires who have the money to build their own family office, meaning the people, the infrastructure to be able to do their own investments, their own legal, their own accounting, everything. They in-house everything that most people outsource to professionals. And so I've got a lot of data on multifamily offices, and that would be, a group of people that would kind of pool resources to hire a team, right? So some of these multifamily offices, they may have 5 or 20 or 200 families that they serve. And so all those people kind of contribute to paying the salaries there. But a single family office, these are the wealthiest people. I mean, to have your own family office, it's going to cost you generally, about $4 to $8 million a year. Wow. And in some cases, I've seen it up to $12 and $16 million a year, depending on, the size and scope and scale of it. So you really have to be pretty darn wealthy to do that, do that the right way and not cut corners. So that data to me is really important. And what we see through and through is that anywhere from 50 to 60% of the net worth of these wealthy people, the wealthiest people in the world, is in alternative investments. And I think that just speaks volumes to the fact that the way most people learn how to invest is not the way the wealthiest people do it. I learned how to invest in the stock market. These wealthy people, they've got 15 to 25% of their net worth in the stock market, typically. And by the way, some groups as low as 5%.
Wow.
Okay. But what do they do a lot of? They borrow against the stock market. So a lot of them don't invest in the stock market for stock market returns. They borrow against those assets to buy other alternative investments. Because if they sold stock, that's a taxable event. If they borrow against it, it's not a taxable event.
Right.
So they use their stock market or public equity portfolio to compound their alternative investment portfolio, which is pretty interesting.
Yeah, that is interesting.
And we could break it down even more. Most of them have real estate between 15 and 25% of their holdings. Most of them have private equity between 20 and 30%. So the single largest holding of most of your billionaire class or your centimillionaire class is going to be in private equity, private companies.
Yeah.
And then something that most people don't know about is private credit, which is, it's fixed income on the private side. So you got bonds and stuff. A lot of people, have a certain allocation in bonds, treasuries. So on the private side, you can get better rates and often much better collateral, much lower risk, but you get higher returns. And with banks not lending the way they were, being more conservative, saying no a lot more, you have all these private companies that are stepping up and they're filling that void. And so you can invest in these funds with very skilled, very proficient people. I mean, actually, I was studying recently that many of the billionaires that exist all have their own private credit funds.
Wow.
Yeah,
okay.
I saw a list of like 15 or 20 billionaires, all over $1 billion in net worth. Actually, I think it was all over $2 billion in net worth.
Yeah.
And so many of them got their start or at least built their wealth in private credit.
Wow. So, okay. So we have private equity, private credit, real estate, any other big sectors?
Cryptocurrency.
Crypto. Okay.
Collectibles. So that could be artifacts, wine, bourbon, whiskey, that sort of thing. I guess, tequila, there's a few, brands that are kind of making their way onto the scene. Cars, watches, like anything that can be rare or have value based on, limited quantity, that would go in that category. You've got, let's call it agriculture, oil and gas. Okay. Sometimes you'll see it showing up in commodities or in agriculture, depending on how it's listed. Yeah. But, that's probably the majority of it. Precious metals as well. You've got some currency. Most people today, though, are way more, when it's a currency thing, it's cryptocurrency. It's not trading other currencies. Yeah. I mean, it's interesting because even BlackRock, the largest asset manager in the world, I think 12 or 13 trillion dollars under management, recommend that people, the average person, have 2% of their net worth in Bitcoin. And at Davos here.
Is that before or after Trump just tweeted?
Right. Well, that was before. That was before Trump. But even at Davos, at this last session, I mean, we're talking weeks ago. They even talked about, that it probably makes sense up to 5%. Yeah. Wow. And I know other people that are considering that, their fixed income. So something I didn't put down was fixed income. Okay. But that would again be kind of like the bond or treasury side of things. And then there's cash. So those aren't alternatives, but this is kind of like the pie chart that people look at. So I just gave you all the, all the slices of the pie.
Where would life insurance fall in? Is that fixed income?
Fixed income. Okay. That's probably where I would put it. Okay. Kind of like more like a bond performance because most life insurance companies are pretty heavy bond, right? So that's kind of the exposure that I think it would make sense.
It's like a better bond that allows you to also collateralize, potentially reinvest in some of this other stuff.
Much better bond, Okay. Yeah, that unlike banks that can literally go out of business, we've seen this happen in the last couple of years. Life insurance companies, it's rare when that happens because they have to have all the cash on hand.
That's right.
Right. So it's these life insurance companies are very strong financially.
And to you as the quote unquote, the investor, the person, there's also tax advantages that some bonds just can't compete with.
That's right.
Okay. So let's talk about, I don't think we could touch on all of these, but maybe we can. I'm really curious about private credit and like understanding your framework there, private equity, real estate. I think those are like the big three. And then obviously I know that you've been becoming more of a fan of crypto. I'd just be curious to hear your thoughts there. And then collectibles always make for good content because it's just crazy. I mean, I think I was talking to a friend of mine the other day and talking about like bourbon and all like investing in, and I was just thinking to myself, like, how crazy is that? But it's like the returns I was seeing, I'm like, is this real life? Is private credit, we'll start there. Is private credit like, there are companies out there that say, Caleb, we can give you lots like 90-day-ish liquidity. We're investing in other deals. We have first lien. So there's like some safety there. So if these people go out of business, we get their, a lot of times properties and stuff, but they were able to give me like a 10 to 11% return on, is that what a private credit fund is? Or is that like what it, talk to me about that.
You'll see private credit in a lot of different industries. You could see it in single family homes and loans for home flippers. You could see it in money for, companies and there can be all kinds of hooks, all kinds of collateral in it. So it can be in a lot of different industries, but private credit is just, the private side of lending money. And in a fund structure, you deal with less risk, because if one of these doesn't work out, you've got, 10, 20, 100, thousands, other loans that likely will work out. And then if it doesn't work out and you have structured it the right way, you've got the collateral that should be more valuable than whatever the loan dollars were in the first place, right? So it's a very popular way of investing. You're seeing family offices now even eclipsing the 5% range on that. You're seeing for a while, it wasn't even a thing. And in the last 5 to 7 years, it's really come on strong, and it's become actually one of the largest asset classes. I mean, this is a multi-trillion-dollar asset class now, which is pretty incredible to think about. And so, I would say we're seeing families anywhere from 5 to 15% of their net worth in private credit.
How would someone that's taking those words apply this to their life? Like, what is the framework, and what is maybe the first principle of how to think about this category, and how we maybe not worth $100 billion or $100 million, how can we still take advantage of this?
Well, just because you don't have that type of a net worth doesn't mean you can't copy the playbook of the wealthiest people. So I think, what I teach our community, everyone in Lifestyle Investor, I talk about this on my podcast, in the mastermind, newsletters, you name it, and in my blogs. My goal is to help people learn and grow their wealth the way that the billionaires do it.
Love it.
So yes, you totally can. Now, there's a lot of garbage out there.
Yeah.
Just because something's private credit doesn't mean it's good, right? I'd actually say there's more bad stuff than good stuff. But if you learn how to vet, this is why I like to teach people. I don't just want them to come into our community for access to deals. We do a lot of that. But I actually want to educate them along the way so they know if something's a good deal or not a good deal.
I love that.
And one of the biggest things you look for in private credit is leverage.
Yes.
Are they over-levered? Or is it an adequate amount of leverage that if everything should go wrong, that they can still maintain
what is
they
that
need to
for
maintain.
You? What is that? Do you
it depends on the collateral, it depends on the industry, it depends on a lot of things. So it's hard to say, but I love a lot of these that have, I'm in some deals where they use no leverage.
Wow.
Okay. And I really like that. And if you can get a good return with no leverage, I love that. But there are responsible ways of leverage. But if you've got 3x leverage, 2x leverage, that's most likely irresponsible leverage. If something goes wrong, it can wipe you out. I think Warren Buffett always would say something to the fact of never use what you need for something that you want. So never invest money you need into something that you want. And I think you got to be careful with leverage and private credit, but you find the right groups. We have a ton of them, and some of them, by the way, we have liquidity within days.
Wow.
Right? We have some liquidity in weeks, but a lot of these give us regular monthly cash flow. Either quarterly or monthly.
And
I love that.
And not all collateral's created equal either. Like a real estate property that's, consumer could be way easier to value than like a business IP. That's like, right. It's a $100 million valuation, but is it really? And so I think that's all interesting to look at right now. And again, this is not investment advice, but what is the range that someone could potentially make in private credit funds?
Oh, probably like 8% to 15% on a safer side. Now we've got a deal that we've done that has paid 20% since the start, since inception, and they're on their third fund. And they've been great. And most people look at it as like, maybe it's riskier, but the way that they have collateralized is just very unique.
Wow.
And they do it with private businesses, and they have, kind of hooks into their assets, hooks into their bank account. Anything should happen, they can actually draw, take money down from the bank account. So there are ways to protect. And then on collateral, just having collateral isn't good enough. Like you've got to have the collateral in a way that is meaningful. So I don't even want 1x collateral. I actually want 2x or 5x or 10x. So if you default, then it really becomes attractive. Like I actually want the leverage on you, whoever, if you're the sponsor, I want the leverage to be so strong against you that you're not going to do anything to default, because it's so bad if you do. I like that setup because it protects me as an investor.
Yeah, I love that. And also you have an incredible mastermind that you do this, and you have an amazing community. And so we'll put all the information, including your book, down below for people that are watching this. Are like, I want to learn more, work with Justin. You guys we'll have links down below.
Love it.
All right, let's talk about real estate. So you read Rich Dad Poor Dad. Okay, I'm financially free when I have enough cash flow to cover my expenses. And oh, by the way, real estate is my magic ticket for that. Obviously, like that was, I think a lot of people get into real estate because they read Rich Dad Poor Dad. It's a phenomenal gateway. But I think it sometimes oversimplifies, like not all real estate is created equal. What is your framework for real estate? Because there's literally like 30 different paths in the real estate world that you could go down. How does Justin think about real estate as an alternative asset?
Well, I think you either A, become an expert in one area,
okay,
and you go deep into that area, or B, you invest with experts that go deep in only one area. So I started by investing in mobile home parks. And that for me was a great play because it is still today the least institutionalized or consolidated asset class. So you have the most, mom and pops, baby boomers running it, the least amount of institutional money in it. So you have the biggest return opportunity. And so for me, owning deeded real estate, like that was really good. Now on the syndicated side where I'm investing with other people, I just found whoever was best in each lane. And so, my second largest holding is in industrial. And so I've got a bunch of industrial partners and between mobile home parks and industrial, they're the two top performing real estate asset classes over the last, close to a decade. So those are my two largest holdings. I was big in multifamily for a period of time. I saw that market changing and I got out.
When did you get out of that?
About 5 years ago.
Okay. How was Justin 5 years ago, able to pivot when so many people are hot and heavy on multifamily?
Well, to me, the prices got astronomical. So when I would run the numbers, I'm like, this is not sustainable. If rates ever change, we're in trouble.
Exactly.
If you can't get long-term debt, we're in trouble. So for a while, I was just investing with groups that would do long-term debt. And if you could make the numbers work there, you could keep making them work because you're on a longer term. So what I should mention is inside of that time that I got out, I had a lot of friends make money. There were a lot of sponsors that made money. People thought I was crazy. People literally told me I was crazy.
3 years ago, even 3 years ago, you'd be like, Justin, what are you doing?
People thought I was nuts. But the difference is, and people would like brag, like, look how much I made on this deal. You should have gone on this deal with me. And I was like, but I couldn't. My investment criteria, like that, I have my own criteria. That didn't meet my criteria. I couldn't do it. You had floating rates. You lucked out that rates didn't change. Right. So to me, like that was, it just got crazy. It got, the numbers couldn't pencil. And I didn't understand how people could stay in it. But here's what happened when the tides turned and trouble set in and people couldn't make their note payments and these sponsors were losing assets and investors were losing money. I didn't get in deals where some of my friends made money and some of these sponsors made money. But I can tell you, I got out of everything. So I wasn't in deals that imploded. And that to me was huge. So I'd rather miss some big hits than get caught, on some deals. And so I got out early. I missed some of that frothiness, but I didn't lose money. And that to me is more important.
Hey guys, I want to just interrupt real quick and let you know something very, very exciting that we're working on. We're compiling a resource that's taking all the alternative assets that you could ever imagine into one place. This is something that I get asked all the time. Caleb, what type of investment should I look into? Caleb, what assets are you looking into? Caleb, all the people that you're interviewing, what are they doing with their money? And what we're doing is we're creating a resource to lay out not just the frameworks, but the different asset classes that you should be aware of and look in. Again, this is not investment advice, but it is going to be one of the most thorough resources out there. If you want to be the first to get it, go check out the link below and sign up, and we'll make sure that you get this for free the moment it's published. I think my mindset has changed quite a bit from like wanting to get better returns to wanting to get returns with less risk. And that's what the wealthy, successful investors, like they're thinking about risk, when I think most of, I'll throw my age under the bus, like most of my generation doesn't even mention risk. It's all about the flash. In real estate, going back to like either being an expert or investing with experts, how do you measure expertise, especially if you're not an expert? And then due diligence. I know I'm asking you two questions here, but they feel like in a similar vein. How in the world do you do that? I'm sure you've lost money. I'm sure you're not you're not perfect, but you have the discipline to well, I mean, I'm telling you, 5 years ago, multifamily was like the thing. And for you to like your investment criteria for it to point you away from that is impressive. And I'm just wondering like how I can learn from that and not just be like, oh, you know, Justin's the man. I want to become the man.
Yeah, sure. Well, that's kind of to say. I mean, here's what I did. I built a vetting deals course. So I literally teach people how to do it. It was a 1-day event. We turned it into an actual masterclass that people can buy. So it's been a huge hit. In fact, I was just hanging out. I had a chance to hang out with 250 to 300 pro athletes just last week and kind of teach some of these strategies and methodologies. And they all got my book as part of the PAC is what it's called, the pro athlete community. And it was fantastic. And the thing that they were most excited about was this vetting deals course, because these guys were doing deals that they probably should not have been doing. In one case, we had a guy who was about to wire when we were there, and we're like, hold on, hit the brakes. Because it was a first time sponsor. And we just knew that we probably should look under the hood a little more. And we wanted to kind of educate this individual, this pro athlete, who will go nameless for now, at least. So vetting, it just takes time. Like I've made a ton of mistakes. The reason I was able to make this course is because I've made so many mistakes. What I'm good at is not making the same mistake twice. That's good. Right. So I will I'll make some mistakes this year. Like there's no way I'm going to learn everything. And cycles change and industries change and investments change and so much changes. So I know that more mistakes are going to come, but if I can learn it well enough, I'm just not going to repeat them. And so, you know, I think that, you know, is kind of first and foremost, you know, what I would say. I forget what your first question even was. Well,
just like, how do you vet deals? Like, and again, the vetting course, that's amazing. Can you give us a couple things, like principles from there that are being like, okay, obviously you should go get the course, but if you weren't, like, here's like 3 things that you look for when it comes to, because I'm assuming the way you look at real estate is the same way that you look at private equity. I would just assume that. I don't know if the same principles apply or if you.
Yeah, plenty are similar. Oh, I know what the first question was. How do you know if it's a good group? Okay, here's how you know. How long have they been in business? Have they been in business for 10 years, 20 years, 30 years? Like that matters. Have they gone through a downturn before? That matters. I want to know how they perform. You know, when you said, hey, like, how do you vet a deal? Like every deal looks good on paper. The deck looks great. Well, I don't care what the deck says. The deck tells me you're going to make me 20% return. That doesn't mean you're going to make me a 20% return. Everyone's deck does that, you know? So that means nothing. But you know what does mean something? What did your last deal that went full cycle? Not middle cycle, not a deal that hasn't completed. What does your last full cycle deal look like? What was the pro forma? And what was the actual? What about the deal before that? The deal before? Give me your last 5 deals. I want to know, can you actually project correctly? Did your pro forma underperform or overperform the actual? That to me is a better indicator how well someone's going to do than whatever they put in the current deck. Because it's fluff. It's nothing. Whatever is in the current, you know, marketing materials, it doesn't mean anything.
You won't invest your money with someone it's their first rodeo.
No.
Okay.
Rarely. Let me say rarely.
Okay. How does someone get to their second rodeo if everyone takes that approach?
Well, unfortunately, a lot of the newbies learn on people that learn some hard knocks.
Okay. So would your advice be if someone was coming to you to be like, hey, work with a group that has a track record and build a name for yourself before go, like, are you pretty anti raising money or going, like, what would you tell someone who's like wants to be an expert at real estate and they're starting to raise money and they've never done it before? Like,
well, I don't think raising money is the best way to learn how to invest in real estate. You know, I think that, and they're all, you know, money raisers are different than operators. So if you want to get good in real estate, learn the operations, learn the systems, right?
You want a long track record regardless if you're wherever you go, of like a long track record to say this is how you made this thing work.
That's right. And then the other thing is entrepreneurs. And I don't know who your target audience is. But entrepreneurs are eternal optimists. Right? They can figure it out. They're going to make it happen. Doesn't matter how much, you know, rain there is. They're going to get through it.
Bad investment.
That is a bad mindset as an investor. Like, entrepreneurs lose a lot of money investing because it's a different skill set. You know, to be a good investor, you need to actually start with the opposite. You know, an entrepreneur is like, this is a great deal. So-and-so's doing it and so-and-so's doing it. And it looks so cool.
Yeah.
These are all horrible reasons to invest, right? You got to go into it and say, hey, this deal's probably horrible.
Yep.
I'm going to see if I can prove otherwise. And so you start with a no instead of a yes. And just that one thing can save people so much money because most deals aren't good deals. So if we can figure out a way for people to say no more than yes, they're going to win.
That's good. And that's a good challenge for people watching this is, are you saying no more than you're saying yes? If the answer is no to that, have a reality check. Any other real estate assets that Justin's looking at right now in 2025 and beyond, like just curious about, wants to learn more?
Well, something I'm really excited about is industrial outdoor storage. So it's kind of like the self-storage of the industrial side. That's more of a niche market, but we've done some great deals and have had some awesome returns there. So super small. It's it's a sub-market, but I think it's going to be big. So I'm a fan there. I do still have some self-storage. It's hard to find good deals on self-storage because it's so institutionalized. There's just so many big players in it. It gets bid up. I found a few good deals. I haven't done a whole lot there, but enough that it matters. And really, and there's a few niche areas. I know people are not big on office, but there are a few niches in office that I think do well when you get to a certain size that only big companies can take them down. Where they actually need it, right? Think about companies that have that need security clearance or government contractors or whatever. Like these companies can't do the work from home. They're not at risk of that.
Doge is cutting, but they're also telling you to come into work. So that's interesting aspect there.
Now, I don't think anyone should start in office, but I've done well in office. But most of office is not performing well. And I would say to most people, to a novice investor, stay away from it. But that doesn't mean that everything's bad there. But really, industrial and mobile home park are the two outliers right now as I see them, as I read the data.
Okay. You want something that's
data centers.
Okay,
data centers are kind of blowing up now. This jury's still out here, and we'll see what that wave looks like. But we could include that as like a hot topic.
So you're looking, and again, I'm always thinking in frameworks. You're looking for something that has a track record, but not such a great track. Like you're looking for something that's inefficient that you can make a greater return on, but also has a track record. So you don't want something crazy inefficient. Is there anything else when you're looking at asset class? Like you want there to be a track record, you want there to be upside. Is there anything else that you're like looking for?
Well, risk always.
Well, which is track record. What other things? What other questions?
Everything goes wrong. Well, how does this perform? Right.
Okay. So you're looking at the market
three cases,
as well.
Right? There's your bear case, your base case, your best case. And you should basically make decisions under that worst case scenario. And can you live with those results? It's probably not going to be that, and it's probably not going to be the best case. It's probably going to be in the middle. But can you live with the worst case outcome?
Keith Cunningham, what's the upside? What's the downside? Can you live with the downside?
That's right.
Great framework there.
Totally.
Okay, private equity. This is the thing as an entrepreneur I love, and my track rect is not great on private equity.
Most
life to date, by the way,
not good.
I'm looking for one to pop. It hasn't yet, but talk to me about private equity and your what you have and what you're looking into.
Well, the thing with entrepreneurs is they love to invest in the next big thing, and they're like, well, because I run a business, I know how to invest in businesses, and it's just it is more nuanced than that. So most people invest in early stage companies when they're investing in private equity. That's the riskiest kind, right? I mean, you've got to get like the professionals, the best of the best have funds, venture funds, okay? And most venture funds, by the way, happen post-seed, right? So there's pre-seed, there's seed, and then there's Series A. That's where most venture capitalists are, most funds. So even at that far into the stage, the best ones out there have funds of 30 to 40 companies and are getting 1 or 2 or 3 right.
Wow.
That's the best. Okay. Anyone that doesn't specialize in this, they're going to do worse than that. Right.
Crash.
And if you're investing earlier than a Series A, if you're actually at the seed level, you need to be hundreds of deals in before you're going to get a return.
Wow.
Okay. So the power law just basically lays out, I mean, think about the greatest people out there. Like Naval Ravikant is probably the greatest angel investor, or one of the greatest angel investors. And this is a guy that, has said, you are really good if you're getting 1 in 50 or 1 in 100 or 2 in 100, right? Like you're really good at what you do. So that means the average person is way worse than that. I was in Silicon Valley. I met with just recently, and I met with a bunch of the tier 1 VCs, many of the GPs that run those funds. And it was really cool kind of learning some of the stats. But one of the stats is that it takes like 412 early stage investments to get a unicorn, so $1 billion company, so or some big pop, some number that covers all of the other investments. And so for most people, they don't have that volume. You only win in early stage based on numbers or luck.
Wow.
And so the odds are just stacked against you. And most people, they think it's cool to invest that early. I like to invest late. I want to know that the company makes sense, that the product or service works, that people are buying it, that there's actual revenue, and ideally that there's actually profit.
Yeah. So you said that 25 to 30% for these family offices are in private equity. Is that because with the 1 in 50 or 1 in 100 or 1 in 400, when it pops, it really pops?
Well, keep in mind, private equity is a big category. Okay. So we were just talking about venture.
Okay.
And venture or early stage, I mean, if you're talking about like seed or pre-seed, like angel deals, most families put less than 1% of their net worth.
Understood. There. Okay. So let's talk about private equity that's not early venture.
So that's early stage. Then you have venture, and that's like 4 to 10%.
Okay.
And then private equity is kind of later stage. And private equity typically only invests in companies that are profitable, that they think that they can 10x.
Okay.
And so, those are kind of like the different tiers. They all fall under the category of private equity, but like a PE firm, a private equity firm they would never get into what venture capitalists get into.
Understood.
All right. So whatever's left over of that, let's call it 1%, and let's call it 10%. So let's say 11%. So now you're at like 20% ish in, later stage private equity.
Yep.
Okay. And in some cases it's 30% or 35%. And so one of my methodologies that's worked really well for me is I have built cash flow first.
Yep.
And I build a cash flow to cover my life.
Yep.
And then anything beyond that is surplus income.
Yep.
And anytime I'm going to make a risky bet. So it's not that I don't do the risky bets.
Yep.
It's that I do the risky bets with the passive income.
Yep.
Because next month the passive income shows up again. I'm not taking principal that could be earning me my lifestyle, right? And still, I only put 1% in early stage.
Yep.
Now, luckily, I've had some hit.
Yep.
And I've got a few that are trending really positively, but they could die at any time.
Yeah, that's right.
At any time.
Yep. Well, and you're humble. You're very successful. You do very well. So for the majority of people that are watching this or listening to this, probably they should be focused maybe on later stage.
Yes, for sure.
And then what's the key there? How do you get into deals like that?
I would just love your audience to know, I actually think I did well in the deals that I did early on because of luck. Okay. Like, I don't actually think I was that good.
Okay, there you go.
I think I got lucky.
Yeah, that's great. Yeah.
Now, you can be a lot better when you know the financials, right? Then it's less about luck and more about due diligence.
Yeah.
But what was your last question?
How does someone get into this world if they're like, how do you join your mastermind? Is it possible? Like, how do you even find these deals to begin with?
Well, it's my network that brings them. And I do think, for me, when I think about where do I want to spend or invest my money?
Yeah.
Well, the places that I want to invest them, 1, myself, my education.
Yep.
2, my peer groups.
Yep.
3, mentorship. So I spend a lot of money on masterminds and coaches and education, because to me, I value that and I know I'm going to get a return on that.
Yep.
So what I would say to anyone that wants to get good at it, well, educate yourself, join peer groups that are real, with with great track records and people with great track records, and hire coaches that are not life coaches. Everyone today is a life coach, right? You know, I mean, literally you're hiring an expert who is a seasoned professional. They're best in class at what they do. And they've been doing it for 10, 20, 30, 40, 50 years. Yeah.
The stock market's easy because anyone can go on there. There's a lot of different real estate funds that people can find. Private credit funds are not the somewhat easy, and maybe not the good ones, but are fine. But like private equity, it sounds like the way to get in. Like if you want to do this well, you got to be connected.
Well, I'd say private credit and private equity.
Okay.
And I would even say like the right real estate deals. Like I think all this, like if you can shortcut mistakes and losing money, then spend what it takes to get around the people that are really good at it.
I love it.
I mean, that's what I would do. Like instead of learning because you lost money, learn by being in groups with people that have lost money, and you can learn their mistakes versus on your dollar.
I love it. Precious metals and crypto, I know they're two separate. There's a debate on gold versus Bitcoin and all. Like, what is your thought process when it comes to gold, silver, and cryptocurrency?
Have them all.
Okay.
You know, I mean, to me, it's like,
I
do. Yeah, I have more Bitcoin.
Okay.
You know, I'm a huge proponent of it. I think it's going to do, I think it has done great things. I think it's going to continue to do even greater things.
Yeah.
But I have some gold.
Yep.
Right. At one point I had silver, but I actually cashed out my silver because it pumped and I was like, wow, this is too good of a return. So I actually sold it all. So I have no silver. But yeah, I have gold and I have Bitcoin.
Okay.
And I think both, like, if you were to ask me which is better, for me personally, I'd say Bitcoin.
Yeah.
But I don't know for sure.
Yeah.
So I'm going to own both.
Yeah. I like that. Oil and gas, obviously.
Oh, by the way, family offices generally own about 1% of precious metals.
Okay.
Right.
Okay.
So 1% of precious metals, 2 to 5% of Bitcoin.
Yeah. And Michael Saylor's, what is it? 15%?
Michael Saylor says, you know, treat it like your fixed income on up to, I mean, he says for maxis, or actually for double and triple maxis, maybe 20% of triple maxi.
But for those people that have all their money in Bitcoin, that's even too aggressive for Michael Saylor.
Yes. Yes. So I mean, he's a big proponent of having somewhere, I think, between 10 and 20%.
Okay. Got it. And then oil and gas, there's obviously tax benefits there. I've also known people, ironically, that have lost money on oil and gas.
I think there's probably more crooks in oil and gas than
is it
virtually anywhere else.
Is it because they use like the urgency of taxes and you're not vetting the deals properly and you're getting in? Because in theory, cash flows, you know, it's an asset that will be in demand. You get tax benefits. It seems like a great thing, but I know people that have lost, and I'm not sure why.
Well, most people look at oil and gas it's like, you can't let the tax tail wag the dog.
Exactly.
So people are like, "Ooh, I'm going to invest in this because I can write this off and pay less in taxes."
Yeah.
Well, why don't you find a good deal that stands on its own, that you don't need any tax benefits, like that is good with or without them?
Yeah.
And then you get the tax benefits. Like to me, you got to do the homework. You've got to do your due diligence. There are great companies out there, great people. We've invested with some good groups.
Yep.
But there are tons of shade balls out there. So you got to be careful. You got to be careful in that space. But I mean, and this is even a bigger, conversation where what's the most important investment people make beyond their education, their peer group, and their mentorship is tax strategy.
Yeah.
And
I was going to say health, but you're 100% right.
Well, we can put health in there too, right?
But no, I was literally, I was going to tease though, if this does well, we'll have you back on to do all, because you have like a whole course that you did on tax. Isn't it like 26 strategies that you vetted? And
the tax advantage is what we're calling it. And 27 unique strategies. And by the way, that's even less than half of what we have in the mastermind.
I love it.
And think about it this way. We have tax strategies, 70, 80 different tax strategies that most CPAs have never even heard of. They've literally never even, like if they've heard of any, they've heard of 5 tops.
Yeah.
And so, but these are all these all stand on their own foot. These are all in the tax code. This isn't some like special crazy thing. Like this is outlined in the IRS tax code, but most people look at the tax code and they're afraid of it, including CPAs.
Yeah,
they're compliance based versus proactive. This is the power of having a tax strategist.
Yeah.
And that is, taxes are your single greatest wealth erosion.
Exactly.
I guess tool or system or mechanic out there.
And you want to talk about scams. There are a lot of people in that space. So it's it's super important to have your eyes open, be aggressive, but also not just take the first thing that's flashy. You have an amazing story that you may not want to tell publicly, but when it comes to taxes and.
Well, our strategies are very time tested, and they have held up, in the toughest situations.
Great. Last question. Obviously, a lot of people that watch this that are in our community are a fan of life insurance. You mentioned it earlier that you have life insurance. What's your framework and how you view whole life insurance? And it's just one of those things where I love people that are in the investment world to highlight the way that they use and look at life insurance, because I keep on saying life insurance is not an investment. And yet most people will comment on our videos like, that's a horrible investment. And I'm like, okay, I can only say it so many times. So just got to let those people be. But I'm really passionate about helping people understand that how to think about different asset classes. And so how do you view life insurance as an asset class?
Well, I love life insurance. And again, I consider it more fixed income.
Yep.
Your returns are going to be similar to that.
Yep.
4 to 6% generally is where you're going to land. And it's not like everything has its place.
Yep.
So there are some people that are maximalists and they're like, but I could be earning 20% on that money. And it's like, yeah, but with a lot more risk.
Yep.
What about the money that you consistently earn 4 to 6% on with zero risk that you can borrow against? And you can actually earn returns in 2 different places with the same money. I mean, that's the greatest leverage there is. So to me, every plan should include some form of life insurance. And if you have a family, you owe it to your family to have it, because, I don't know that anyone would just get up in the middle of the night and just ditch your family, like not tell them where you're going, just take off, just totally disappear. And they're left with no financial means. But if you pass away and you pass away early, that's the financial implication of it. Right. So I do think that having life insurance, and for me specifically, it's whole life insurance. Mm-hmm. And before I could afford whole life, I had convertible term.
That's right.
But I just think it's important to have that in place, because you are building an asset that you can use as a bank. You can borrow against it. There's a death benefit in case anything happens. Hopefully nothing happens. But let's say nothing happens. There's also a living benefit to it too.
That's right.
And so I'm a huge proponent. I've had it since I was 24 years old.
Justin, you are so fun to talk to. What are the call to actions for people that are like, hey, I want to learn more? You have a book, you got courses, you have a phenomenal masterminds. Where do people begin in getting into your world?
Probably the best place, just go to lifestyleinvestor.com. We have everything from free items to low cost items to, more intricately priced items. But for your audience, what might be fun, we normally do these strategy sessions that are $500, but I'd love to just offer it for free to anyone in your community that reaches out. So if you go to lifestyleinvestor.com/consultation,
awesome,
you can actually get a free strategy session with one of the people on our team that can actually walk you through your situation, how to get from point A to point B.
Awesome. Thank you. Thank you for that. And Justin, appreciate you. And